demand's been affected over the years? Because it sounds like you mentioned there's been a bit of a migration out of some of the cities. Do you see this trend kind of staying the same, or do you expect it to change?
So what we saw during the pandemic is that on prices, everywhere boomed. Even the places that lost population, everywhere boomed. It was essentially an everything housing boom for prices during the pandemic with that elevated demand for space. But since the rate shock has occurred, we've seen a lot more bifurcation in the market. And this has happened regionally, this has happened on price tier, this has happened on product type, all of these things. And what's happened is that some of the places in the country, prices ran up so fast, so long, and this even goes before the pandemic boom. Think about like the West Coast with the ZIRP era, low interest rates, the tech booms. Prices had moved up on the western part of the country at a faster rate than the rest of the country. And so in those markets where, in the West in particular, and some of these boom towns, prices got so high above rents and that these on a price to rent ratio, that when mortgage rates spiked, the affordability shock there was so strong because so many people were already priced out that some of those markets then gave in some on price. So San Francisco, Seattle, they gave in some on price. Austin and Boise, which really was a function of like the Zoom town pandemic era housing boom effect, where local prices just went so high so quickly above local fundamentals, then those markets gave up some, right? Now, we did see a bit of a stabilization in the prices entering 2023, whereas in the second half of the year, some of these boom towns and Western markets had given up on price. That kind of fizzled out a bit, with the exception being Austin, that continued to really stay in correction mode through the first half of the year. But now, as we're in the second half of the year, we are seeing some pockets that had stabilized start to see some prices work down a bit. Maybe it's just kind of giving up the spring gains from this year. We'll kind of have to see. But I will say the biggest area of weakness is regionally in the country right now is less West Coast, which was the second half of last year. And now it's more pockets throughout Texas and then Louisiana, New Orleans in particular. So Austin and New Orleans being the two that are very much in correction mode. But if you flip it and you look at the whole country, the Northeast and the Midwest has many markets where prices continue to go up this year. Hartford, Connecticut's up 8%. And so what's going on there? Well, some of it is like a donut effect that's happening in some of these metropolitan areas where people are kind of realizing, oh, work from home isn't going to be like I can work anywhere. It's kind of getting reined in a bit, but hybrid is still a thing. And I don't necessarily need to live all the way close enough to commute 5 days a week, but maybe close enough to where I commute 2 days a week. And so you're seeing a lot of pockets of like New Jersey and parts of Connecticut and these donut areas around these bigger metros get an increase in housing demand despite the elevated mortgage rates. That's one. Two, you're also seeing that while some of these markets out west in these boom towns, price to rent ratios got so distorted that investors couldn't really cash flow properties. They couldn't go buy a home and then at that monthly mortgage rate, charge a rent that was above it to make up and have a cash flow, right? So a lot of what was out west and even parts of the South didn't cash flow anymore. So where could you find cash flow still? Well, some pockets of the Midwest and Northeast, in particular, at the bottom third of the market, some of those single family homes could still cash flow. That's another part that helped to aid the Northeast and Midwest this year. Another factor is, and this is really nationwide, but it just felt more acutely in the Midwest because of the cash flow bit in the Northeast. But as mortgage rates went up, as mortgage rates go up and the monthly payment moves up, it's not like then prices have to fall enough to equal that out. That's just not how it works. But what does occur is there's a shifting of expectations. And so a lot of people who would have bought a home at like 2,300 square feet, maybe you're now looking at 2,100 square feet, looking at 1,700 square feet. You got 3 kids. Hey, maybe we still do 3 bedrooms and 2 of the kids share, something like that. And so what that's done to the marketplace is it's pulled some of the demand from the top down to the bottom. And so despite some people getting priced out altogether, that bottom of the market is staying warmer because some demand has shifted down to it. But it also means the top has gotten cooler. And so when you look at luxury prices versus the entry-level prices nationally have continued to rise on a year-over-year basis. Luxury prices, the top third of the market, or the real luxury, which is usually considered the top 10th of the market, prices are down nationally. They're down a few percentage points. And in some markets like San Francisco and San Jose, where that affordability shock is more acute, they're down like 15% plus on the luxury end. And so that has helped to keep some of that bottom of the market more warmer. And of course, all of that is felt more acutely in the Midwest too. And there's another factor here at play, which is when mortgage rates move up, the trade cost to sell your home and go buy a new home, so giving up your monthly mortgage payment to take on a new monthly mortgage payment, the trading cost gets a lot higher, right? So it could be $1,000 more to go get a new mortgage, a new home at today's price, right? And so a lot of people are just saying put. They're like, F that, this is too unaffordable, I'm not going to do it. So what occurs is you have less supply of the churn coming into the market, and it's more so at the bottom because the people who would sell their home and go buy something new would have been like move-up buyers, like people who were like, okay, I have 2 kids, now I have a third, time to get a bigger house. They're not doing it. And so that takes off more supply from the bottom. And since they're not going out to then buy something, that takes off more demand from the top. So where these the mortgage rate shock has had an effect and a pullback on supply and demand, but in some segments, in some parts of the country, one has moved back faster than the other. And that's the gist that's creating this bifurcation where you have some markets that are in correction mode and then some that are not only moving up still, but are actually moving up at a pace that I would almost consider overheating. I mean, Hartford and some of these pockets like Knoxville, Tennessee, they're up 8-10% year to date.